This is episode 3 of the Stock Market Stories podcast. I haven't released an episode in a few months, but with the massive market volatility that we're experiencing in Q1 of 2020, it seemed apt to talk to an investor who's actively seeking opportunities in these markets. Today's guest is Chris DeMuth Jr. Chris is a partner at New Canaan hedge fund Rangeley Capital, where he focuses primarily on event-driven, value-oriented investment opportunities. He also runs the Seeking Alpha community Sifting the World, where he looks for mispriced bets in event-driven situations. Chris got his start by investing in unscalable odd lot opportunities in high school. We didn't have time to touch on this backstory of his, but I highly recommend listening to his appearances on other podcasts like Hedge Eye, Seeking Alpha Roundtable, and Microcap Investing. I'll link to these in the show notes. For reference, this episode was recorded on March 27th, 2020. And a disclaimer here, this podcast or other material published or distributed by Stock Market Stories and related entities does not constitute investment advice. Investing in the financial markets comes at a high level of risk, and you can possibly lose your entire investment. Any securities mentioned are not a recommendation to buy or sell. For more information, please see the disclaimer at stockmarketstories.net/investment-disclaimer. Please keep in mind that this interview was recorded on short notice and it was a call-in interview over the phone. So the audio isn't the best, but it's very listenable and quite bearable. One of your main strategies, you say, is instead of buying distressed assets, you want to buy those assets from distressed counterparties. So where do you see the most significant dislocations due to that phenomenon today?
Well, in 2008, 2009, the process that was kind of my favorite time to wake up to actually act was called the BWIC process. I am a fairly frenetic researcher, but not trader. I kind of actually pull the trigger fairly sleepily. But kind of my ideal environment is a bid wanted in competition auction where a very highly leveraged entity is getting their portfolio sold out from under them by somebody who only cares about getting their collateral. So if, they are, call it either leveraged 10 times or 20 times, something like that, the person who I'm interacting with only cares about getting their collateral back and are pretty indifferent as to what I pay. And so you kind of wake up in the morning and say, here's a portfolio of, say, loans, and I want you to buy it. And if you say no, then I'm going to keep lowering the price until you say yes. That's the kind of conversation I like to be on the other side of. And we're not quite there yet, but things are getting closer and closer. And then you have examples such as WWE was probably the first to kind of wake up to a founder forced sale where the market, the vast majority of the time, is able to accomplish many things at once, including provide liquidity and assign value. But in a crisis where people are simply taking liquidity, there are times and places where it really breaks down in terms of its role of assigning value. It's not really measuring things probabilistically. It is just providing those liquidity that people demand. The way I think about it is that you have every right in the world to be time sensitive or price sensitive. You just can't be both. And I kind of try to define the poll on the most time insensitive and most price sensitive. So I enjoy research. I am able to rush if there's a reason to rush. I am able to wait if there's a reason to wait, and just have everything based on a price that seems to be ideally not just good but nonsensical, where there's an actual structural anomaly to the price, and it's usually with a counterparty that is in a situation that they never contemplated being in, that they didn't want to be in, but that they're in, and that is going to be more and more available as this kind of crisis environment unfolds.
Right. So can you give any examples of trades you've made or situations you've been offered during today's market?
Sure. I think I can tell you some kind of categories and some examples within those categories. And it's really in the latter half of the quarter. I mean, the first half of the quarter, markets were very expensive. Volatility was very low. They were kind of complacent markets, and it was frustrating for me. I could spend all day looking for something that was an anomalous price and not find anything. I had kind of people I trust who are great researchers, and they would report back to the same thing. In hindsight, that was much more of a data point than a failure. And if you can't find something, then that's often fine. But just some kind of categories and then some specifics. I'm very interested in closed-end funds that trade at substantial discounts to NAV. The way to think about it philosophically is I'm bearish on the concept of investor talent. I think, at least in publicly traded vehicles, there may be a very, very few where you can hire a talented asset allocator who's durably an advantaged player. But the antithesis of that is it makes me fairly comfortable with randomness, because I don't think that many people are that much better than random that you invest in. So if there's a real NAV, then I am super skeptical of ever paying for it. Never premium, rarely at par, especially if, as is often the case, if there's an indefensible cost structure associated with par. But at a big discount to a real NAV, I tend to get interested. So for one example, in looking at closed-end funds, Gabelli has a deal fund, GDL, and I've been, of course, following merger arb opportunities. And you can think that you're good at it or bad at it, but once there's a massive discount, you could actually think, oh, I'm as good or maybe even better than the guys at Gabelli. I don't know. But if you thought that, you could still do better buying their fund if you can get it at a huge discount to NAV. It's come back a little bit, but it's still at an 18% or so NAV discount. That fund, a GDL, is one that I think is pretty interesting. But the drama this year, even more than the closed-end fund, there's actually been many examples recently of ETFs that have broken. For example, HYD, the Van Eck Vectors High Yield Municipal ETF, it's reconverged a bit, but it had for a long period of time traded right at NAV, as ETFs tend to, since 2009, and then just this month it broke. And when I say it broke, it was trading, just think of it as roughly $65 for both the NAV and the market price. But at one point, the NAV had collapsed to, the high 50s, call it about $60 a share, and the market price had gone almost to 40. So just a huge, huge discount to NAV. It's recovered quite a bit, but it's still a substantial discount for an ETF. So, I mean, something that is well known to have these discounts went from small to huge. Something that is presumed to track NAV even broke open this past month. So that's something where just one stock price, one market price is wrong or the other is, but they can't both be right at the same time.
Right. So it's safe to say you haven't gotten those calls from people that have margin calls just yet.
Not quite yet, but it's the kind of environment where you expect that. And in the case of HYD, even though I haven't gotten to the bottom of precisely what happened, I would say that was a real anomaly. And then if you look at the deal market, there have been some that I would say there are some fairly real risks involved, but the collapse and the recovery has been, in many of these cases, it's recovered, call it half or maybe a bit more than half in some cases from the high to the low. But there have been some, ARB spreads in M&A ARB that are as big as I've ever seen and declines that were as fast as I'd ever seen, in some cases wiping out the full deal premium, so that if the deal's closed, you're getting the full premium from here. Tiffany was one that was particularly pronounced given the circumstances, that really, truly collapsed. It's recovered a good bit. But where I'm looking in the deal environment is I'm looking at deals that are strategic with long-term strategies that brought the buyers to the deal. Deals that are going to close very soon are nice because you can recycle that capital and perhaps get a profit, get your principal and your profit back, and then recycle that with lots of other opportunities out there. Looking at deals that were announced fairly recently, so they were announced knowing the COVID-19 pandemic, deals that explicitly carve out pandemic risks. And those are some of the things that I'm looking for. Deals that might have in months past given you some comfort that there was finite downside and breaks, has much less of that kind of argument right now. I mean, there's probably very few deals that would not be pretty ugly if they broke. But one of the amazing opportunities right now, and I actually have a fund dedicated to this, is in special purposes acquisition corps. There are spreads in SPACs that you can put a whole portfolio into, and one of my 3 strategies is doing just this, that are wider than merger arb spreads usually are, with no equivalent to broken deals. They're trading at a big discount to T-bills. They have T-bill-like risk and double-digit rewards from here. I just can't imagine somebody actually buying directly T-bills when you can buy equities that you can redeem for the T-bills in their trust. And that's probably not as hot as some other strategies right now, but from a risk-reward basis, the best thing out there.
Can you briefly explain what a SPAC does?
Sure. So an IPO is a fairly antiquated process for going from a private to public company, and there's a lot of arbitrariness in it, including the arbitrariness of bankers and others who are compensated for getting the transaction done, coming up with IPO prices. I've always been a big skeptic of the process. I think it's kind of odd and unseemly to watch people celebrate because they just sold something that they used to own and now you do. And I also think it's kind of odd when they celebrate going up a lot, because if I've sold something to you and then it goes up a lot, I priced it badly. I don't know what one would celebrate. Ideally, they would just be kind of very sober and businesslike for a few years, and then they'd celebrate performing well. But if you're going to celebrate anything, I think the flatness of an IPO in the public market would indicate that you priced it well. If it went way up or way down, somebody erred. In any event, it's antiquated and arbitrary. A SPAC is special purpose acquisition company, in which sponsors first raise an amount of capital and then have a number of years, typically 2 years, to buy or fold in a SPAC target, an operating company, into their SPAC. These founders tend to be people who have monetizable reputations coming from private equity or the hedge fund world, or successful CEOs in the industry that they are targeting. Ideally, people who have a very good pipeline of deal opportunities in a business that they can take public through this process. From the outside shareholder perspective, you buy, if you participate in their offering, you typically get a unit, which is a combined equity with a kicker, typically some fraction of a warrant. But just focusing on the equity for a second, you have all of the money you invest goes into a trust. That trust is invested in short-term, typically T-bills with a duration that matches the remaining time in their life. At the end of their life, a couple of things can happen. They can either fail to find a deal, then they have to return the money to you, and it's roughly as if you had simply invested the money in the T-bills. Or they can find a deal that is a fantastic deal. And cynically, it doesn't even have to be a deal that you love, a deal that the market loves, and then you can sell inflated shares. Or perhaps it's a deal you authentically want to invest in, and then you can participate, and then you own that as if you were a pre-IPO equity investor. Or you can simply redeem for the cash in trust. Or if the market likes it and you don't, you can sell the inflated shares. So in an event, if it goes horribly wrong, you still have the downside protection of the cash in trust. So picture having spent $10, you get a warrant too, but setting that aside, you'll sell it for $10 and a few pennies more based on the interest in their trust. If it's a popular deal, you might sell it for 12 or 15, or occasionally sometimes it's kind of will be some mania, like was the case in Virgin. That was probably one of the more famous deals, in which case the stock can go haywire. And you have that kicker of the warrant. Sometimes you have other rights or other securities as well. But from my perspective, we think about everything probabilistically, everything you own, all of the probabilistically weighted outcomes. So I'm most interested in the downside protection. Now we invest in our other funds in all sorts of parts of the life cycle of SPACs, but for the sake of the conversation about the current opportunity, which really seems to be spectacular, is something that's protected by this trust value has plummeted in the past few weeks, plummeted relative to the actual fundamental downside. It doesn't look as dramatic as a lot of other securities in the past few weeks, but the prospective returns on them look very good.
Wow, that is very, very interesting. And I saw in Seeking Alpha you posted a few articles about those, so I definitely recommend listeners check that out.
Yeah, I'm always ambivalent on how much I write about the specifics because, I'm in my day job acting on this, and I would like to be able to, of course, raise capital, put that capital to work, and do it in a timely fashion on one hand. So you need to tip your hand a little bit about what you're doing. But on the other hand, I'm not that excited to be endlessly knocked off when I think it's something that's still great. But that's, I kind of just muddle through and do my best to split the difference between those two sides.
Cool. So the SPACs and the closed-end funds trading at a discount kind of ties into my next sort of question, which is investing for multiple possible outcomes. So, of course, I'm sure everybody has their own view on what's going to happen in the coming weeks and months with coronavirus, but no one really knows. So how you like, how do you think about positioning yourself? Because all of our predictions about GDP and these things are kind of out the window right now. How do you position yourself with the massive level of uncertainty?
It's a good question. I don't have any single specific prediction. I like to think of investing as a process of just being a counter, not a soothsayer. So I'm kind of just looking at where there's value, with the big caveat that right now there are many, many companies whose common stock value is zero because they simply are too exposed to an economic paralysis that we are in. I've looked at every model I can and tried to understand everything I can about this virus and about its economic impact. And there are wrenching trade-offs between horrific health outcomes and horrific economic outcomes. My view is the societies have done the best that simply prioritize responding head-on to the virus, suffering the short-term economic consequences, and they can recover well and ultimately be 2-0. I think that the societies that kind of commingle, worrying about short-term sales numbers in the virus are probably going to end up 0 for 2 in terms of a good virus and good economic outcome. So there are wrenching trade-offs. There are not a lot of miraculously pieces of good news that I could imagine popping up. I've talked to virologists, epidemiologists almost every day, and they seem much more uncertain and much more skeptical of a lot of good news theories that finance bros or politicians float. They say, well, I've worked on this every day for 15 years, and I've never heard somebody mention that. Is a comment I've gotten actually more than once, floating ideas, especially on the how it might be better from here than is widely imagined. And it could be a lot worse. But in that environment, I think that there will be this kind of bifurcation of companies that can and can't just shut down for a number of months. If you look at the current ratio that companies have, if you are too indebted, and a lot of people just didn't have projections that kind of went this low. If you look at 2008, 2009, one of the, I think, funny things about models that looked at residential home finance was that it didn't even allow for negative numbers. I think that there's a lot of models that didn't allow for this level of economic stoppage. So we're going to have a lot of bankruptcies. I think that there's a lot that's just beyond the scope of fiscal and monetary policy that the stimulus, even at the pace they're going, just won't touch. So being kind of sorting cleanly, certainly if you're looking at equity, into survivors and non-survivors. I kind of tongue-in-cheek was writing about Google to pick an extreme case of a company that gets criticized for its cash pile. But I said, if you've had a litany of investors complaining that they have an underutilized balance sheet, that's probably a good place to start in terms of who's going to survive making a list. But that list is going to not necessarily be a long one. So So yeah, you know, somebody that's valuable, undervalued for the long term, but somebody who's going to survive to the long term. You need to be a survivor, and you need to be invested in the survivors so that you get there.
Interesting. Cool. So, you know, you don't have to speculate too much, but outside of like the really obvious ones, like the cruise industry that we hear on the news a lot, which are the industries that are going to be hit like immediately, like if they're not already kind of filing right now?
Well, the cruise line industry, I mean, it's probably the most obvious case in that it's probably the least justified in terms of bailout money. You know, you could look about halfway through the equity downturn, kind of if you look at the second half of this quarter, the way I've been thinking about it roughly is first and second half of the quarter, there were other equities such as airlines that were down about the same amount, but with a much stronger case for getting bailed out than an industry that is foreign flagged, pays little if any taxes, and is kind of a frivolous pursuit, and has been somewhat irresponsible in this crisis. So I think that they'd be kind of last in line in terms of the kind of legitimate rationale. Politicians are throwing around money, but a lot of people will get it. But they would be kind of close to my last priority for bailout money, and any industry that's just or company that is over leveraged, especially, you know, when you look at the very short term, if things really kind of seize up for them for a month or two, if you can't survive, well, these will be the months when you won't survive. I think I would also look at I said I'm skeptical of the kind of the IPO process. You know, you look at fads and frauds on the short side. You also look, in many cases, for us, the IPO process is where the very kind of, if anybody had anything that was attractive about the equity, you usually kind of get it out there. And many of the companies that went public to get exits for insiders. So, you know, I think that we look to things that have IPO'd in the last couple of years. And in some cases, as much as I am a fan of SPACs, you know, while they are in the SPAC stage, once they de-SPACed, I would say that our skepticism of these is very high, and we found a number of good short opportunities amongst them. And so sometimes they're kind of gimmicky companies that shouldn't really necessarily be public. Maybe there was a good reason they weren't public already. And if you look at the need to get a certain number of the investors to participate and not to redeem their shares or vote against a deal, they'll tend to be something that I'm willing to tolerate a lot of superficial pain if the substantive value is really there. These are often the opposite, where there's a lot of substantive pain, but the superficial appearance, the story is attractive at some level. So I think that there's quite a few of these that are just in a bad industry with a bad business model, underscaled, and with a need to raise a lot more capital, sometimes with leverage. So those are kind of the ones that are of a lot of interest to me on the short side. Oh, I should also add, with the overhang of the other securities that unit holders get along with their equity. So they also then have the overhang from the warrants and so forth. So you're getting diluted all sorts of different ways, and there's an implicit dilution from the further rounds because a lot of these aren't that big. You know, somebody raised a few hundred million dollars. It's not a big public company. So either they're very leveraged or they're going to dilute you with a number of rounds of equities. And sometimes these are projected by a kind of verbal diarrhea of press releases, where things that seem to be weirdly unworthy of comment get press releases, and then 5 minutes later they're trying to issue more equity.
Right. Yeah, it's like the classic microcap, like penny stock fraud thing. So I only got you for another minute, so I want to leave you with this last question, which is, your marketplace sort of membership on Seeking Alpha is called Sifting the World, and it details all of these mispriced bets with really skewed expected values. And a big thing I've seen is that you try to emphasize opportunities outside of the capital markets as well when they have really great IRRs. So can you just tell us, like, really broadly, like, how to think in that mindset, like how to sift the world?
Well, I emotionally have always been very scale agnostic. If I can put $100 million to work at something, that makes me happy if it's mispriced. If I can do it with $10 or $100, I'm not as happy about it. But I like finding anomalies. I think that I'm always estimating. I'm always aware of prices and value, and I'm just thinking about what roughly makes sense. And I get bored of things that are about right. If I'm dealing with the kind of people who are the people you would want to, say, manage a private company that you owned, you'd say good stewards, 100% honest, smart, clear communication. When I get that in the public markets, it looks a lot like an efficiently run operation with an efficient price, and I have nothing much to do. As soon as I see evasion or deception, I get very, very interested. If somebody implies that I shouldn't ask the question, this doesn't happen anymore, but a few decades ago, if they said, you're just a kid, why you don't understand this because you're too young or you're too ignorant about our technology, kind of the counterattack type reaction from managements were very interesting to me on the short side, clearly. But whenever there's something that's just off, so I put together a complicated model a while back. There was one Asian airline that had extremely good crosstabs from other airlines on their loyalty program, so I could kind of watch all these flights and prices around the world. And I would, this was before kids, it's not as practical once you have a family, but before I had a family, we would buy up plane tickets opposite anybody that was on strike, because we could so easily get bumped from the flights, and we would travel around, and we were kind of professional bumpees, where we would just, weeks on end get bumped from one flight to another. And it wasn't highly lucrative, but it works out to about like $300,000 or $400,000 a year if you did it full time. We didn't go full years, but we'd go weeks on end, and then you could sometimes negotiate extra benefits for getting bumped off of flights. Sometimes they're specific to in airlines. You'd get cash, or you'd get the ticket. But that was something that I was very interested in. Stock market TV shows that occasionally had recordings on the background if you were call-in, and they'd be market moving, but they would record ahead of time and move in after hours when the show was live, but you could just listen to it on the background when you called in. It was interesting. Things like that, quirky credit card opportunities, or opportunities to get, in a very low interest rate environment, it's actually not that trivial to get sign-up bonuses. And so you can just take an amount of money and just keep bouncing it around. Federally insured, so do it with less than $250,000, but just take the same amount of money and just keep bouncing around between different types of accounts that offer bonuses. That kind of thing I've always been amused by. It was the kind of thing that I think I spent a lot of energy on when I was a kid and in high school and college. I do it less myself now, but it's a nice thing for me to be able to write about, because if you have a few hundred people who can take advantage of these things, it's scaled up a little bit, and it's kind of fun.
Cool. Yeah, I know firsthand you made me $50 with that SoFi Invest or whatever it was, the bank account. So thank you for that.
Great. And that's an opportunity also of this kind of Silicon Valley bubble, where they're able to take in, just hundreds of millions of dollars from investors for companies that don't really necessarily make that much money, but that are able to show growth. So they just use these referral and affiliates and sign-up type cash payments. It's actually kind of a funny market. They get to show the growth that their VC investors will pay anything for, and then you just get the money passed on to you. It's kind of the perfect thing. Again, not that scalable, but fun and an anomaly that's indicative of the kind of thing that I like to do.
Thanks for listening to my interview with Chris DeMuth Jr. of Rangeley Capital. Again, it's been a while since I've published an episode, and I do intend to get on a more regular schedule. It would really help out if you guys can leave a review on the Apple Podcasts platform or anywhere where you listen to podcasts, as well as sign up for the email newsletter where I'll send out notifications of new podcasts. You can do that at stockmarketstories.net. You can find the show notes for this episode at stockmarketstories.net/3. If you guys would like to email me to give me ideas for new guests or anything else, you can email me at stockmarketstories@gmail.com. Until then, I'll see you at the next podcast. Please subscribe on YouTube, Apple Podcasts, anywhere where you get your podcasts, and leave a review if you like the show.